Every year, thousands of startups raise millions of dollars from investors. Some raise 5 million, some raise 50 million. And yet, within a few years, most of them quietly disappear. So the real question is this: if they had money, why did they still fail? Today on Capital Breakdown, we are breaking down why most startups die even after raising millions, and why funding is not the same as building a real business. Raising money feels like success. Founders celebrate, headlines get published, social media calls it a big win. But funding is not profit. It is borrowed time. When a startup raises $10 million, that money is not revenue. It is investor capital, and it comes with expectations. Aced growth, bigger teams, aggressive expansion. This is where the pressure begins. Most startups start spending faster than they should. They hire too many employees. They spend heavily on marketing. They try to scale before fixing their core business model. Growth hides problems. If a company is growing quickly, investors feel confident. But inside the company, unit economics may already be broken. Imagine spending $100 to acquire a customer, but that customer only generates $80 in lifetime value. That means the company loses money on every customer. Now imagine scaling that loss to 100,000 customers. More growth, bigger losses. Many founders believe they can fix it later. They assume profits will appear once the company becomes bigger, but that rarely happens automatically. Another major issue is burn rate. Burn rate means how fast a company is spending its cash. If a startup is burning $800,000 every month, the runway becomes short. When funding slows down, investors become careful. Suddenly, startups that depend on new funding rounds feel stuck. No profits, no new funding, no runway left, and then they collapse. The truth is simple. Funding does not fix a weak business model. It only delays the consequences. Strong startups focus on unit economics early. They make sure each customer is profitable. They control costs and grow step by step. Weak startups focus only on valuation. They chase headlines and ignore fundamentals. Raising millions is not the goal. Building a sustainable business is. That is the difference between hype and survival. At Capital Breakdown, we focus on these fundamentals, because fundamentals decide survival. Now I want to ask you something. Would you choose fast growth or early profitability? Share your answer in the comments and subscribe to Capital Breakdown for more serious business case studies.